Here are the basics of basis. I'm Leandra Letterman.
And I'm Allison Christians, and it's time to break into tax.
We're going to break down for you the somewhat complex but foundational topic of basis so that you can understand what it does and how to use it.
Now, just a couple words on vocabulary. For the US, basis is the term you'll use in all situations. In other countries, you might see basis, but you also might see something called cost base. Same idea, just a different word. Now, the rules might differ quite a lot from jurisdiction to jurisdiction, but the basic idea is the same. That it takes money to make money. So if it takes money to make money, we got to keep track of the money it took for us to make the money that might be subject to tax.
That's right. In general, basis tracks investment. It increases with increased investment and it decreases with divestment.
One other caveat we should make is that we're really going to focus here on individuals and not think too much about entities like corporations. Why? Not because it's a different concept. It's the same idea. It's just that it gets a little bit more in the weeds. And we want to start here with the basics. So let's talk about the three kind of big picture areas for basis.
So there's acquisition of an asset. There's adjustments to basis during ownership of that asset. And then there's eventual disposition of that asset and what happens to basis at that point.
I like to illustrate the idea of basis with a beaker. No, not that beaker, this kind of beaker. So here's the idea. It's really basic. Generally speaking, we'll see later that it gets more complicated. When you acquire something for cash, the money that you paid to get that thing is the basis that you have to keep track of. So we're just gonna pour it in the beaker. You see that there is the red at the bottom. And then let's say later you make improvements to your asset. Well, now if you're allowed to deduct that, nothing's going to happen to your basis. But if you're not allowed to deduct it because you have to capitalize it, well, you got to do something with it. What do you have to do with it, Leandra?
You adjust your basis upwards.
Right. So we're just going to add that new expenditure to the beaker and let's make it blue so we can see that it's different than the initial one. But we don't keep them separate once they're in the beaker. They mix together. Now they're purple in the beaker and it's all your basis. And then
there might be the possibility of recovering some of that basis over time, what's also sometimes referred to as cost recovery. And for tangible assets, that takes the form of depreciation deductions. For intangible assets, it's the same idea, but it's called amortization, which is just recovery of amounts over time.
So when you get to take depreciation or amortization, you get to pour a little bit out of that beaker. What we're saying is that's the amount you're allowed to deduct.
Right. Visually, what you're seeing is that reduction of the basis in the beaker.
Exactly. And so now you come to a day when you decide you want to dispose of the asset in some way. Well, you still have that beaker and maybe there's still some basis left in it. So when it comes to disposition, whatever you have left in your beaker, that's what you're going to use to compute your gain or loss for tax purposes. That's it for the basics of basis.
Thanks for joining us as you break into tax.